Welcome everyone to our quarterly outlook video. My name is Kevin Dehod, President and CEO with CWB McLean & Partners, and I'm pleased to be joined today by Ric Palombi. Ric leads our international equity and alternative income teams. Welcome, Ric.
Thank you. Great to be here, Kev.
And as you can see, we're in our Stampede duds. Today is the first Friday of the Calgary Stampede, and Ric, as we sit here, I think Kevin Costner is downtown Calgary right now as the parade marshal leading the Stampede Parade.
Actually, I just saw him drive by, I think.
Well, we are close to downtown, so you never know. He might have got by and made a cameo on our video here. So now, speaking of stampedes, there has been a stampede out of equities this year, but there's also been a stampede out of fixed income. Fixed income's been very volatile. So that's actually what we're going to talk about today. We're going to talk about the fixed income markets and not the equity markets. And I kind of want to kick things off with a great chart that kind of sets things up as we'll talk about our fixed income discussion today. What this shows is the rate of return of the US stock market going back to 1928 to 2018, but it only shows years in which the stock market was negative. So basically it's a chart showing the number of occurrences of negative years since 1928. And as you can see, I'll help you by counting it up for you quickly. There's been 25 times when the US stock market has been negative. And the green bars show what the bond market has done during those negative years. And in most of the occurrences, the bond market has been up when the stock market has been down. However, 1931 and 1969, both stocks and bonds were down that year. And here we are in 2022, and we've got stocks down about 20%, and we've got bonds down about 10%. So I thought we'd start there.
Yeah, I mean, difficult times, but we've seen a lot of weird things happening over the past few years. And normally, why it's so unique is because normally what's good for bonds is not good for stocks. And normally what's good for stocks is not good for bonds. And they have that, in finance terms, that negative correlation. This year, the difficulty is they've both been positively correlated to the downside. So there's been really no place to hide for investors. And that's been difficult. And the reason simply is because both don't like uncertainty and they don't like surprises. And the first half really has been characterized by both. And the biggest surprise has been inflation, which ramped up very, very quickly and surprised a lot of investors as well as central bankers, including the Fed. So if you remember, the Fed used the word transitory to describe inflation. And because of that, we had yields spike dramatically from the beginning of the year from 1.5% to 3.5%. At the same time, obviously that surprise in inflation caused the stock market as well. And obviously the war in Ukraine also caused the stock market to decline. So we had this sort of double whammy effect driven by inflation, the surprise inflation, and the fact that the Fed was behind the curve at the beginning of the year and moving into obviously the first half of the year.
Right. Okay. So the Fed was trying to regain their credibility by fighting this war on inflation. And I guess the question is, so that was the first half of the year. So as we look to the second half, does that narrative continue, or where do we go from here?
No, I think the narrative now is changing. So even though we're still, we have headline and front page inflation, the inflation story, behind the scenes, the narrative is definitely changing to one from inflation to growth. And the reason is that the Fed is fully now engaged and focused on fighting inflation, which means as investors, because the Fed is so worried about inflation, we don't have to be. I don't say that lightly. The reason I say that is if we put up this chart here, which we're going to look at, this is simply a chart of 5-year forward inflation expectations. It's one of the Fed's favorite charts to look at. It's market-based. And you can see that in the first half of the year, it peaked at about 2.6%. But recently, it's come off dramatically, and right now it sits at about 2.07% or so, which is very, very close to the Fed's 2% long-term inflation target. So this is just one reason that we're seeing that says that inflation is yesterday's news and not what's going to be the driver of the second half of the year, which provides opportunities, we believe.
Yeah. So what I'm hearing is if bonds were negative 10, 12% for the first half of this year, if the story transitions to growth, and growth is kind of going away or dissipating, where there's this big recession word obviously going around out there, we could see positive returns from bonds in the second half.
I agree. And I think the narrative is changing such that growth is becoming the story and inflation is the backstory. And with growth, the risk reward on fixed income now going forward from here is actually very compelling. So with the Fed firmly in inflation fighting mode, now it's about how much damage do they do to the US economy. Currently, markets are pricing in about a 38% probability of recession in the US. That's up from 0 at the beginning of the year, so a big ramp up there. And if those recession bells start ringing louder, then, I mean, obviously fixed income looks even more attractive. But even if they don't, and we have no way of knowing, the point is that from a risk reward standpoint, fixed income looks quite compelling here.
Okay, good. Well, with that, let's dig into the portfolio a little bit more and look at how our fixed income portfolio is structured.
Sure.
I just wanted to start things off by putting up a pie chart of the diversified fixed income fund that you manage, and you can see, there's a certain percentage in corporate bonds, preferred shares, not very much in government bonds. But what I really want to highlight to our viewers is the current yield on the portfolio. You can see the current yield on this portfolio today is 5.70%. So I'll say that again, as a new investor putting capital into this fund or dollar cost averaging, you're buying a fixed income portfolio at 5.70%, and we haven't seen yields like that for 10 years plus.
For sure.
Yeah, and so I think the message is not to abandon fixed income, but to keep it as a core part of your portfolio and even be considering adding it to it. So Rick, maybe we can get into a specific portfolio example of a company you've been investing in on the fixed income side.
Sure. Well, one of the things we're thinking about is because the yield curve is so flat, which means in some ways inverted, which means that shorter term yields are higher than longer term yields. So it doesn't pay an investor to move out the curve and go 5 or 10 years or 30 years because the yields on the shorter end of the curve are very attractive. But we want to do even better than that for our clients. So short-term yields in the US are a little above 3%, but we want to do, obviously do better for our clients. So one of the things we've been buying and adding to the portfolio is a bond from Intesa Sanpaolo, which is an Italian bank, one of the largest banks in Europe. It's a bank we own in the international pool, and we know the balance sheet, we know it very, very well. But the bond is a 3-year callable bond. So it can be called in 3 years because the structure of the bond is one where it's a convertible, COCO convertible bond. So that particular style of bond is callable, as I said. And we see by the chart here, if we can just put up this chart, it not that long ago was trading at 115, and now it's trading at 90 cents on the dollar. At 90 cents on the dollar, thereabouts, the yield to that 3-year call is 11% compounded annually.
Wow.
Which we find very, very attractive. If it's not called, the yield to the next 5 years when it's called is 9%. So we feel the risk reward on that particular bond is very, very attractive for our clients. And we've been, as I said, we've been adding to it during this downturn and taking advantage of that volatility.
Yeah, wow, that's compelling. I've got a 3-year bond at 11% compound annual rate of return. And obviously, if you're buying it at 90 cents on the dollar and they call it at par, there's nice...
There's a $10 capital gain there.
Capital gain potential
for
as well.
Sure. Super. And that's why, with the yield at 5.7%, you're getting paid to wait. So, you're getting a nice income and you're getting potential capital gains down the road with bonds like the Intesa we've been talking about.
Super. Okay. Well, Rick, thanks very much. hope probably next quarter fixed income will be settling down and we won't be talking about fixed income and making our way back to equities. But this was a fascinating discussion on the fixed income portfolio and the opportunities available.
Yeah, thanks for having me. Happy to do it. Thanks, Kev.
Thank you, everyone. I hope you enjoyed my conversation this quarter with Ric Palombi on fixed income. I want to thank all of our clients for your tremendous support, your trust, and your great referrals. I hope you have an amazing summer, and I look forward to talking to you this fall.